B2B bars, part 2, some longer term looks at it. If you're not familiar with what these are, it's something that I thought about a better way of looking at the same thing. I was racking my brain over a trip that I went to in Florida about a month ago, and I said there's got to be a better way to go over these transitional moments. That was the title of an earlier meeting that we did maybe a year or two ago in this track 4, right? So 2 weeks ago, we had B2B bars where I started showing transitions from on a 4 PNF when a market would go from bearish to bullish or bullish to bearish, hence B2B. And on a 4 PNF, as most of you guys know, it's a small, short time frame look at the market. It could get noisy for some people. A lot of you guys like a 6 PNF for the ES or a 6 or 8 PNF for the NASDAQ. So the higher number you work on a point and figure, the less bars you're going to have. Makes sense. The smaller the number, the more bars you're going to have. If you don't know that, you got to go back and look at the PNF videos we've done along the way in track 4. So with that being said, it's safe to say that the bigger number, point and figure you use, the longer time frame you're looking at, right? More of a helicopter view of the market. The smaller the number, the more drilled down you are getting. So 2 weeks ago, if you haven't watched that video, watch it, and then you could come into this one. But the whole thing is, how do you create and help fit a strategy, a setup that is more along the lines of your personality and style instead of maybe mine or somebody else's in this room? Just another great way to look at the same thing. So even though I've got this slide for a template to introduce this segment in this meeting, I want to pull up charts. And I've already got this chart looking at a 12 PNF. So typically and traditionally, I like 4, as most of you guys know. A 12 is obviously going to give you less bars, and it's going to give you, again, that helicopter view of what's going on. The higher away from, if you think of when I say helicopter view or airplane view, the further away from the ground, the more you see, but the less detail you have. The closer to the ground, when you're on the ground, is where you're going to end up being when you execute anyways to get in or out of trades. So, but obviously there's a lot more noise and detail when you're on the ground. And another thing is when you're on the ground, you miss a lot. You tend to miss a lot. You're in the bubble, so to speak. When you lift yourself off the ground, you're on the outside looking in at times, and that's where a longer time frame approach could fit people better, or at least give them another perspective. I've always said that shorter time frame traders, it's not imperative they know what long time frame guys know, but long time frame guys, it's imperative to follow what short time frame guys are doing, because it will definitely increase your locations, your good locations. So going over this 12 PNF, same concept. When I highlight a bar, it means it went from one driver to the other. It went from the bulls being in control to the bears being in control. Okay? Let's look at one bar, though, could encompass 2 or 3 hours of trade. Again, it's not like a 4 PNF. This is a 12 PNF. 24, I think it's too big. But at 12, you still get what we want to find, and that is the rotational look at the market. You still kind of could see that in the 12. And it would be outlined like that. All right. One thing to know, though, is in any one of these bars, let's take this one, for example. There's a lot of rotations going on within this bar, right? There's maybe a few bullish to bearish, bearish to bullish bars that are happening on a 4 PNF in one 12 PNF bar. Make sense so far? That's why when you take a different perspective or a helicopter view of a market on a 12 PNF or 24 PNF or 60-minute chart, there's a lot going on in one bar. That's why you got to always drill down. There's always a lot going on in a longer time frame look at the market. I'm half giggling because I get a text from my wife. I asked her if we had plans this weekend. She goes, no, but you do know our anniversary is this week. And I'll reply, of course, I remembered. Even though I didn't. But anyhow, we go to this 12 PNF. This is where we're at now. Here's where it got a little bullish. But let's not analyze this as a 12 PNF. Let's analyze this as at some point you're going to put this bearish, you're going to put this highlight on this bar. And I would assume that you did it after it got through those two. Once it got through that, when it was, let's say, down in here, and you can be a lot more patient when you put these in because it's slower, it's more methodical, right? So you highlight this bar, and you do it right in here, okay? And now it's a bearish transitional bar. So from this point forward, and just stay with me on this, this stuff hasn't happened yet. But from this point forward, from the time you make this 12 PNF bar a bearish bar, you're only to take trades when the 4 PNF is in a bearish transition also. Because remember, a 12 PNF could be in a bearish transition, but a 4 PNF could be in a bullish transition, right? That makes sense? Because that's going to happen. You want that to happen. That has to make sense for you, by the way. For the rest of this meeting concept to make sense, that has to make sense. That the 12 PNF could be bearish and a 4 could be at times bullish. That's got to make sense. Hopefully it does. All right, so now let's go and say around 5:30, 6 o'clock this morning, Central Time, is when we would have taken a 12 PNF back to bearish. Forget about what it's done in here, bullish, bearish. Forget about that. All we know is that this bar here would have went from bullish, which was in here, to bearish now. Once it cracked through what would have been good support. All right? And it might not have cracked through that. It might have bounced off it a few times. And then finally, once it got through it, is when you would have made this a bearish bar, right? So now, after 5:36 this morning, as a 12 PNF watcher, bears have the leash on that time frame. So then we open up our 4 PNF, okay? And on our 4 PNF, we come back down. This is not the same chart you're used to looking at the trading room. I stripped out the profiles just to clean it up. You're not supposed to take a bullish trade, number one. This could be a rule. But you're not supposed to take a bullish trade, and you shouldn't take a bearish trade just because the 12 PNS went bullish until the 4s go bearish. Just because the 12 went, I'm screwing up the bullish bearish. Just because the 12 PNF went bearish doesn't mean you have to take a short. You have to wait till the 4 becomes bearish. 12 is bearish, wait for the 4 to become bearish. So the 4 might already be bearish, like right in here, before the 12 went. All right? So if it wasn't, and let's just say, because I don't know exactly what time that 12 PNF would have went bearish. I wasn't watching it at 5:36 this morning, so I don't know what time. All I do know is that right here, the market would have went on a 4 PNF from bearish to bullish. This is a 4. So now you're like, okay, the 12 is bearish, but I can't take a short trade until we get this 4 to go to a bearish transition. And that would have been right here. And you would have done this in real time. You better not have to wait for all this to form. You should know, based on the B2B, is that when this went bullish, what's it always going to ask you? You should always ask this question after you put in this bar. What's it going to take to go the other way? Like, what's it if it's a bullish transitional bar up, what's it going to take to put in our bearish bar? And it would be support taken out. And that could change meaning, this thing could have really rallied up and it could be something else that happened way higher. But initially, it would be when this gets taken out. And you could see it hold a couple times, right? And there. When they take it out, then we go back to bearish. Now, the 12 has stayed bearish the whole sequence, obviously, right? And now, when the 4 goes bearish, you're to look to take rotational trades into resistance, which is into here. And it works. If it doesn't, whatever. But that's where you need to do your work. That's how you're going to take a long time frame idea or bias and qualify it better with a short time frame skill set. It's what a lot of people have been looking to have done, and this helps do that. And it keeps you, for some people, it eliminates a lot of this, a lot of the noise. Sometimes I want the noise eliminated, or sometimes it's too noisy for me. Helps you back out. So let me go over that. A 12 P&F chart would have went bearish at around 6 a.m. this morning. But you got to wait for the 4 to go bearish before you look to take a short trade. And you should look at good areas of overhead resistance after the bearish transitional bar were to be put in place. All right. So let's go on to another example. Oops. At 9 o'clock this morning is when you would have had, let me see something here. At 9 o'clock this morning, you would have had this entire bar retraced in here, taking the 12 from bearish to bullish, right? Long down up bar on the 12. Shouldn't retrace this high if it's going to stay bearish. So now on a 4 P&F, I don't know when this happens. I think this happens around 9 o'clock when it finally retraced the whole thing. Now you go on a 4 P&F and say, I'm only going to take long trades. So you go to a 4 P&F. And after 9 o'clock, let's do this because I already have it marked from the trading room. Let's just show you this. After 9 o'clock, this was a bullish bar up. You would have lost money on this trade or scratched it because you would have waited for the bullish transition. The 12 went bullish. The 4 goes bullish right here. You'd have bought down into support right there. You might have made a little bit of money, but you probably would have lost money, and that's fine because this went on a 4 P&F to bearish, but then when it went back bullish, you'd look to play again. And hopefully, if you were playing any long trades, you made money on them because you were buying back the support, and obviously the right side was up, and we had our best move eventually right in here. And it stayed bullish. If you weren't going to get yourself in trouble playing it from the long side because it stayed above that support for a long time and kept kicking up. So let me just recap that last example. The 12 went from bearish to bullish, but you got to wait for the 4 to go to bullish. It does right in there. A decent location, not a great result, but not an awful result. This goes bearish. The 12 P&F doesn't go bearish, just the 4. When it comes back bullish, you rub your hands together like Mr. Miyagi and you put the trade back on. Or you find a location to play it from your bias, your side. Now, where are we at right now on a 12? You're still bullish, right? If you take this out, you'd go into a bearish transition. Then you would look for short trades. Now, this is going to keep you out of fading. If you like to fade and you like to sell highs and buy lows, this is going to keep you from doing that. That's a separate setup. Sometimes fading is great because you pick a better price net. Sometimes it's awful because you get your face rearranged. So you got to make sure that if you're fading, you're a good fader. And don't just be, I'm going to trade a fading strategy, but I suck at it. And if you suck at fading, this will keep you from fading prematurely. Sure, you're not going to get the highest price to sell or the lowest price to buy, but who cares? There's good locations within the range. Then you could add something like Bruce just said and confirm your bias with an ancillary. So the market's giving you the bias. It's no longer yours. I'm trying to keep focusing people on that. It's not your bias anymore. It's the market's. So you could personally detach yourself from your opinion. What do you think? Well, it's not what I think. It's what the market thinks. That's what I'm going to say to people. Anthony, what are you thinking here? Well, I don't think anything, but the market's thinking this. That's why I don't care if I'm wrong, giving my opinion every moment to moment to moment in the trading room for so long, because I know I'm right a lot more than I'm wrong. I know my reads are good, and I'm helpful to people, but mostly because I don't care about being wrong, because I'm not wrong for long, and I'm not personally connected to it. I'm not insecure about being or feeling wrong, and if you're insecure about being or feeling wrong, you're going to have trouble pulling the trigger to get out of losers. Because at that very moment, you're admitting to the world you're wrong and you're losing money. That double sucks. You're admitting you're wrong and you lost money. But that's part of trading, so you got to have that plan going into it and be secure about being wrong. The bullish to bearish B2B bars are going to happen much less frequent on a 12 P&F. That makes sense. They shouldn't happen as often as a 4 P&F, right? But if I blow up this 12 P&F, we're in a bullish transition still. So you would only be taking long trades on a 4 P&F. However, right in here, you'd have stopped. Did I have a bearish transition here? You would have stopped, okay? Then going on, you would have potentially started again if that's a bullish transition. This was after the room. I didn't pay attention to the markets much between 10:30 and 11. So if this is a bullish transition, and it probably should be, you bought back and you probably lost a little money if you took it. But you didn't get killed. Because you're only supposed to be playing when you're in a bullish transition. Right now, you're back to bearish. I would say this turn this into bearish. You want to see some losing trades in any setup and strategy you're reviewing. Because if it's too good to be true, it's not going to work. This is a drill down moment for people. Now, I could come up with, in our workshop, detailed setups and strategies. I'm not going to do that in the workshop. I'm focused on talking about some topics that are the same in a lot of respects to what you guys heard at this event, and then there's a couple new things. Most of the new stuff edge guys are going to hear are going to be from Steenbarger and Kepler, and then me and Kepler on day 3. There's going to be some overlap in stuff that you hear me present, but that's not bad. And then there is a couple new things. The day 3 presentation by John and I collaborating on profile setups, how to qualify them with PNF and footprint. We're going to break into small groups on day 3, teams, and we're going to show some profile setups. Would you buy it and sell it and where? And then go over if it's not about being right or wrong, but if it's in agreement with what I think and what he thinks. I'm getting off on a tangent with that because B2B bars are important. Then the other thing I'm going to talk about is this. Another great way to look at the same thing as far as these imbalances are concerned. $12 looks better, Mike, and I agree, than an 8. He was looking at trying to do the same thing, but using an 8, 12 looks better. I think 12 gives you a nice, not too general look, but general enough. When I say general, you're not too far away from the ground, but you're not too close either. Yeah, so maybe it wasn't a bullish bar. Is that what you're saying, Les? I wasn't watching this in here. I would say it probably was. But what's neat is that you don't have to take a lot of heat to be proven wrong. That's what you want to. When you're studying setups and when you're mapping out potential entries, if you're not taking a lot of heat and you're wrong, relatively quick, but you're not wrong 3 points later, and that's not the losers you have to take, that's when you get excited about trying to now be consistent with that strategy. That's what these are, Bill. Yeah. The one thing you want to do when you're reviewing and trying to create a setup and identify it is don't try to make excuses for the losers that might pop in it. For instance, all right, I'm supposed to be buying it in here and it lost. What could I find out that could have kept me out of this trade so I don't have to say it would have been a loser? Maybe there is something, but don't look too hard. Take it. It's a marketing expense and you're in business. There's outliers all the time that are good because you're promoting consistency. There could be something obvious in here that would not get you to trigger along, but if there's not, skip it. There's a nice lack of obvious sell stop below, meaning my sell stop would not have been below here. It's too obvious. Here's how this would have worked. If I was long in here, I'd be out here, never here. And you know why? Because this bottom X is an obvious stop. And here's what happens in the life of a trade. And this isn't trading. This is falling in love. You fall in love with a trade because you put your stop far away. But because it's in an obvious spot below the bottom of this consolidation, goes against you a little bit, comes back, you feel good. Goes against you a little bit, but doesn't stop you out, comes back, you feel good. Goes back against you, you feel like crap, but not that bad because it comes back. Should I scratch it? No, I won't. Well, I got to stay in it because it's what my strategy says, and then you get taken out for a full stop. And you have to deal with all this nonsense emotion that she never loved you in the first place. Quit calling her. Fall in love with people, not trades. So if you could keep yourself from obvious stops, could keep yourself from trades that a lot of other people are taking. Now you could do this with you guys that want to trade stocks. You could do this with the NASDAQ. Obviously, you've got to massage the PNF number to find something. A good rule of thumb that I used pulling this up was, do I still feel like I'm reading the rotation? You know what I mean? It's still rotating. Because here, I'll show you a 24 PNF. Here's a 24 PNF. To me, it's just like, I can't even see the houses, you know. I'm way up there above the clouds. It's just splat. I mean, what is cool, though, is you could see this consolidation get taken out in here. You could see this bar I highlighted as a bearish bar. So you would only be taking trades to the short side until this red imbalance gets taken out. See that? This happened yesterday morning at 9:30. So if you only played it from the short side in the last session and a half with good locations, you probably have done okay if you were playing it from a 4 PNF. Because remember, yesterday we turned around and came off pretty good. Closed at 35, opened a little lower, ran overnight down to 30. Just play with it. We're starting to get weak right now. This would have kept you, let's say, in this example, let's look at a 12 PNF. I'm hoping this is happening. Good. This is a bearish bar as soon as it got through this double stack PNF, right? Or imbalance, right? So the 12 one went bearish. But you can't take a short trade unless you're in bearish mode, and you are. I don't know if this retracement happened at the same time. I doubt it. That's why this exercise, what I was about to say, don't go into looking back too much. Do the exercise as you're studying and reading the markets in real time, so you know what time this stuff happens. You know what time you would have put the 12 PNF to a bearish bar, and if you had an opportunity to sell it because the 4 went bearish. As soon as it got through 33.75, which just happened, this went bearish, this went bearish. But you see how this, being a bearish bar, would have kept you from taking a long trade and getting stopped out as it sailed through the open? This is kind of familiar to yesterday, remember? Only happening a little later in the session. We blasted through the VWAPs and the open without any hesitation. They got some stuck longs. This is an area of resistance up there. It might not even get up that high and give you a chance. So the exercise is to be done from the present forward, not something to look back at, because your times could conflict, and you don't know exactly what time that 12 PNF would have went bearish. Peter's got Vice Chairman Fisher. Not generally good things at the present is what he is yapping about. Thanks, Peter. It would be foolish to think risks have been eliminated. Calls for close monitoring of risk appetite. Here's another moment of clarity. This is some skill, and it's not unheard of to have it because you guys are with us. You're not with me, you're with us. A breakout. The moment the 12 PNF is about to turn bearish, and you're already in bearish mode in the 4 PNF, and you know that the bottom of this consolidation is being taken out, and you get some bearishness from a headline. You play the breakout. That inflection moment of 1 of 12 is about to go the other way. This will eliminate a lot of noise for people. I hope you liked it. Went even a little longer than I thought, but that's a way to look at a B2B bar without the noise. Drill it down. John and James think they're coming but haven't signed up yet. Anybody else think they're coming but haven't signed up yet for the workshop? Many of you guys are coming, so I'm really happy to see everyone that's coming. I'm looking forward to meeting you. I actually got in my head visions of what each one of you guys look like for some reason or another. Yeah, you too, Mike. I know what Bruce looks like, and Carl met them, but I don't know what anybody else looks like. I'm going to cut the recording now for those watching it at some point in the future. Just make sure if this doesn't make a lot of sense to you, you probably missed the B2B meeting 2 weeks prior. Make sure you watch that.